Welcome to this explainer. Today, we're going to demystify the complex, completely invisible plumbing of the global financial system and really look at how it essentially rules the world we live in. We all interact with money every single day, right? But we rarely stop to think about the architecture underneath it all. So we're going to uncover the fascinating story of the US dollar, how it managed to keep its grip on the world, the heavy costs of everyone relying on it, and the cracks that are, well, definitely starting to show in its foundation.
So let's dive right into this incredible paradox that basically defined global finance after the Bretton Woods system collapsed back in 1971. You see, before 71, the US dollar was actually tied to gold, and then all the other global currencies were tied to the dollar. But when the US closed that gold window, the rules of the game just completely vanished. Yet somehow the dollar remained on top. And what came next wasn't designed by some grand international treaty. It actually emerged purely out of habit. It was the habits of central banks, the way commodities were priced, and just the sheer structural inertia of a world that had spent 3 decades organizing itself around one single currency. So, a habit turned into a dependency, and that dependency turned into a massive geopolitical reality.
Part 1. The Accidental Dollar Standard. Right out of the gate, this new accidental system faced a massive stress test. In retaliation for American support of Israel during the 1973 Yom Kippur War, a coalition of Arab oil-producing nations slapped on an embargo, and the price of a barrel of crude oil violently quadrupled in a matter of weeks. It literally shot from $3 to nearly 12. I mean, just imagine your daily commute costing 4 times as much overnight. Global growth completely stalled, inflation surged everywhere, and the entire world was plunged into this grueling decade of stagflation.
Which brings us to Part 2, Birth of the Petrodollar.
Now, out of all that severe economic chaos came a monumental but kind of quiet pivot. This wasn't announced with flashbulbs and a big press release. It was hammered out through bilateral diplomacy by U.S. Treasury Secretary William Simon in the mid-70s. Let's look at the mechanical loop of this deal, because it's fascinating. Step 1. Saudi Arabia agrees to price its oil exports exclusively in U.S. dollars. Step 2. In exchange, the United States provides military protection and preferential access to weapons. Step 3. The Saudis take their surplus dollar revenues, these are the petrodollars, and recycle them right back into U.S. Treasury securities. This loop effectively anchored global dollar demand directly to energy. Suddenly, every single country importing oil needed U.S. dollars to pay for it. The dollar wasn't backed by gold anymore, it was backed by oil.
And because every nation now needed dollars just to keep their lights on and their cars running, foreign central banks began aggressively accumulating U.S. debt. Just look at the scale of this. Global dollar reserves held by foreign central banks sat at roughly $300 billion in 1980. By 1990, that number had doubled to $600 billion. And by the year 2000, it crossed a staggering $1 trillion. The rest of the world wasn't just using the dollar anymore. They were hoarding it. And by doing that, they were effectively subsidizing American borrowing. It allowed the U.S. government to finance its debt at super favorable rates, while American consumers got to enjoy much cheaper credit.
Let's move to Part 3, the cost of dependency. Now, this highly convenient arrangement definitely had a dark side when the global financial weather changed. In 1979, Federal Reserve Chairman Paul Volcker decided he needed to break persistent U.S. inflation, so he hiked interest rates sharply, peaking at over 20% by 1981. Now, it caused a deep domestic recession in the U.S., but for the rest of the world, it was absolutely apocalyptic. Developing nations across Latin America and Africa had borrowed heavily in cheap dollars throughout the 1970s, so when Volcker jacked up those rates, the cost to service those debts absolutely skyrocketed. Mexico declared a debt crisis in 1982, quickly followed by Brazil, Argentina, and dozens of others. The crazy asymmetry here is that the United States could mechanically export the pain of its own domestic policies to the rest of the world. One nation's currency was suddenly everyone else's problem.
Fast forward into the 1990s, and the dollar basically won by default. In 1991, the Soviet Union collapsed, completely removing the last major non-dollar economy from the board. Then in 1992, China actually pegged its renminbi to the dollar to fuel its massive export-driven growth. But then, the 1997 Asian financial crisis hit. Countries like Thailand and South Korea had attracted huge amounts of dollar-denominated capital. When investor confidence flipped, violent capital flight took over, and because their debts were all in dollars, they couldn't just print local currency to fix the problem. It gave emerging markets a visceral, incredibly painful lesson about exactly how vulnerable they were to the US dollar.
And man, that painful lesson drove emerging market central banks to hoard an absolutely staggering $4 trillion in reserves by 2007. $4 trillion. Just wrap your head around that number. It's like they were paying this enormous invisible insurance premium, locking up money in low-yielding U.S. Treasury securities instead of investing it in their own domestic bridges or schools or hospitals. All of this just to protect themselves from dollar volatility. Holding enough cash to repay dollar debts in a crisis was incredibly costly, but as the Asian financial crisis had just proved, the alternative was way worse.
Part 4. Lender of Last Resort. This deeply entrenched global dependency completely set the stage for the ultimate stress test. When the 2008 financial crisis erupted right from within the United States, the mechanism that transmitted that pain globally was the dollar. When global panic spiked, everyone wanted to liquidate their assets to hold cash. And in a crisis, cash means dollars. This created a massive, immediate global dollar shortage, which just amplified the panic even more. So, the Federal Reserve was forced to step in unilaterally. They opened swap lines with 14 foreign central banks, essentially lending dollars to foreign institutions to stabilize the world economy. In that specific moment, the Fed became the functional central bank, not just for America, but for the entire dollar-denominated global system. Nobody else had a lever like that to pull.
Which naturally brings us to Part 5, a crisis of trust.
You know, we constantly see headlines about BRICS nations creating shared currencies or Russia and China expanding their non-dollar trade, and all this talk about the inevitable de-dollarization of the world. But let's look at the actual reality in 2024. The dollar remains overwhelmingly dominant, holding roughly 58% of global foreign exchange reserves. The euro sits around 20%, and the Chinese renminbi is at less than 3%. So, despite all the geopolitical noise in the headlines, that dominance is undeniably still there right now.
The reason for this enduring dominance is actually incredibly structural. The switching costs are just way too high for a simple government announcement to instantly override the world's financial plumbing. Think about it. The U.S. Treasury market remains the deepest, most liquid sovereign debt market on Earth. It's pretty much the only place a foreign central bank can safely park hundreds of billions of dollars at once. Add in highly accessible American capital markets and massive network effects where global contracts, commodities, derivatives, and shipping invoices are almost all written in dollars. When you stack all that up, you quickly see why walking away from the whole shebang is incredibly difficult.
But the questions being asked today aren't just economic anymore. They're geopolitical. Let's look at 2022. Following the invasion of Ukraine, the United States froze approximately $300 billion in Russian central bank reserves that were held in Western institutions. Impartially speaking, from a purely structural perspective, this action fundamentally changed how the world views the neutrality of that global financial plumbing. It clearly demonstrated that the issuing nation can, and will, use the currency infrastructure itself as a tool of foreign policy.
And the message received by governments worldwide following that freeze was pretty precise, and for many, quite chilling. It fundamentally altered the perception of what a reserve currency actually is. The takeaway was that dollar reserves are no longer viewed as unconditional assets. They are assets held on terms set by Washington, and that raises some entirely new, very serious questions about the political conditions under which a global monetary system can actually function safely.
Ultimately, this whole global financial order isn't really just about gold or treaties or specific institutions. At the end of the day, it's a story about trust. The original architects of Bretton Woods understood that. The system we have today relies entirely on the trust that the rules apply to everyone, including the nation writing them. And that leaves us with this final, really provocative question. Will the current alignment of power and stability persist? Can the world's largest economies continue to organize their finances around a government whose own domestic politics and foreign policy priorities don't always align with global stability? Whether that trust holds strong or finally erodes is the unwritten chapter of this incredible story. Thanks so much for joining me for this explainer, and we'll catch you next time.